24 seconds away from the opening bell this morning. Good morning to you all. This Thursday morning, 24 hours, 23 hours away from payrolls. Equities pulling back from yesterday's monster move higher, down by about 1% on the S&P 500. Futures negative on the Nasdaq by 1.4. On the Russell, down a little more than 1 full percentage point. There's the opening bell. Switch at the board and check out the bond market all over the place. At the front end, the long end, throughout the whole Treasury curve today, back up 8 basis points and back through 3 percentage points on a US 10-year. The dollar showed a bit of weakness off the back of chair power yesterday, now showing some strength against the euro. Euro dollar 105.61, negative 0.6%, and sterling earlier getting absolutely crushed. Looking at some of the opening moves then in the stock market, let's get over to Taylor Riggs for more. Hey, Taylor.
You know, John, I want to take a look at shares of Etsy again and Wayfair. We've been talking a lot about e-commerce stocks this morning, not only the year-over-year comps that they have to digest, but of course, sort of when yields are rising, how you're thinking about growth at any cost. Indeed, Etsy, of course, disappointing guidance, already down about 50% year-to-date. Wayfair, similar story, really worse than expected adjusted loss per share. Again, 52% loss for this year alone. Royal Caribbean's interesting. The revenue broke $1 billion for the first time in 8 quarters, but it still was sort of a big loss on the bottom line and still waiting for that big rebound in travel. The CEO saying inflation and yes, supply chains still continue to weigh on some of that full year earnings guidance. I have to do it. It's Twitter. You're up about 3%. John, you mentioned the breaking news, of course, earlier about being a temporary CEO. Elon Musk, at least on a balance sheet income statement perspective, finding an additional $7 billion worth of financing. So that would bring his margin loan, his bridge loan down from about $12.5 billion to about $6 billion, perhaps maybe in theory making this a little bit less risky and bringing in some big buyers. I think Fidelity, Brookfield Management, Larry Ellison, formerly over at Oracle, so bringing on some big names, Qatar as well to help him out.
Might be great news for Twitter shareholders. I don't know about Tesla, though, Taylor. And also, what is it about this stock, this name, and part-time CEOs? Wasn't Dorsey the CEO of multiple companies a few years ago, Square?
Really good point. I think that maybe Ed Ludlow, who knows the story better than I would say that if anyone could do it, it is Elon Musk. He's been running multiple companies for multiple years. Really hard to bet against that guy. But you're right in terms of maybe that's why it's temporary instead of full-time, why they wait for a full-time position.
Taylor, awesome. As always, great to catch up with you. About 2 minutes in, we're down about 1.1% on the S&P. Yesterday was just a monster move. The biggest one-day pop on the S&P 500 going back to 2020. Is that rally from yesterday sustainable? Big question, Kelly Lyons. No one really knows the answer to that at this point.
No one knows the answer, John, but it also doesn't really look like it this morning, considering you are seeing a reversal in risk sentiment. Not only was it the best day for the S&P 500 in about 2 years yesterday, it was the best performance on any Fed day going back to 2011 and the best performance on the day of a Fed hike going all the way back to 1978. Because yes, this did indeed come even in the face of a 50 basis point rate increase and the promise of more of that size coming in meetings. So how dovish was this really? Was this just a market that had gotten ahead of itself in terms of hawkish expectations and the idea of a 75 basis point hike? I would point to Cameron Kreis and his Macro Man column out on the Bloomberg terminal today saying just because it's not getting worse doesn't mean it's going to get better. And of course, it has not been good for equity or bond markets in the anticipation of tighter policy. The S&P 500 down more than 10%, nearly 11% year to date. For the NASDAQ 100, that big tech index, it's been much worse, down 18.5% at this point. And of course, that has a lot to do with higher yields. We're up 150 basis points on the 10-year Treasury just year to date, and real yields are back in positive territory, which of course puts pressure on high multiple growth stocks in particular. When you put all that together, higher borrowing costs, the pain in equities, collectively, it has had the effect of tightening financial conditions pretty materially. When you look at the Bloomberg Financial Conditions Index and kind of take out the pandemic panic of 2020, this is the tightest we have seen financial conditions going all the way back to 2018. And in theory, as the Fed continues to hike, as QT gets started in June, that should be the case, although it certainly wasn't the case yesterday, John.
How things change, how quickly they change, just like that. Just a couple of comments about 75 basis points. Kelly, thank you. Thank you very much. Perhaps tells you more about where we were than where we're perhaps going in this equity market, where we were and how much we were priced in this bond market. Goldman's Peter Oppenheimer is pretty bullish, constructive. Take a listen.
We are bullish of equities on a relative basis. We've got reasonable upside into the modest double digits over the next 12 months in most equity markets because we think some of the tensions that investors are clearly focusing on and some of the uncertainty about where rates will peak and how weak economies will be will start to fade over that period.
Joining us now, Chris Harvey of Wells Fargo. Chris, fantastic to catch up with you, buddy. I was just reading through your note. The focus shifts from real rates to break-evens. This is a bit different to what I heard a little bit earlier in the show, Chris. Just explain it and we'll work through it together.
Yeah. So John, as you know, we've been talking about real rates normalizing for some time, and they have. And the thought process was as real rates would normalize, cyclicals value would begin to work, and those growth at any price type stocks would really start to roll over. And that's more or less occurred. Now, the reason why we're shifting from a focus from real rates to break-evens is if you look at real rates, they're no longer at a tail, right? They were historically low for a long period of time. Now they're back to zero, and we don't have as much information there. But when we look at break-evens, we have a lot more information because they're at multi-decade highs. And one of the things that we're beginning to say is, hey, we're going to use break-evens as a guide for growth. If we start to see break-evens, quote-unquote, break, we think that's very good for the growth style and growth investors. But until we see that break, it's still going to be tough sledding for them. And the reason why we want to see it to break is because if it does, what that means, monetary policy is really starting to influence the market, really starting to impact the economy, supply demand starting to come back in line. In other words, the economy is slowing down, and that's better for growth.
Chris, do you have ranges in mind that will indicate when to make a shift one way or the other?
Yeah, so what we want to see on the 10-year break-even, we want to see that range of 250 to 275. Once we start getting down below 275, I think that's a pretty good indication that monetary policy is beginning to work, and that's a good time to start to move back into that growth side of the equation. We think sometime over the next couple months we should start to see that. Right, monetary policies just started to tighten, but that impact should begin to be felt relatively shortly because markets have already priced that in very aggressively, very quickly.
Chris, this is a compelling framework. Have you back-tested it? Has this worked over the last year or so?
Well, so the answer is your definition of back-testing. Have we looked at it and has it worked and has it shown an indication? We've looked at our growth at any price type portfolio. We've looked at our reopening portfolio, and we correlated that to real rates. And there was a very key connection between those all those relationships. As real rates went higher, what we saw is that cyclical portfolio or that reopening portfolio did outperform. As real rates went down, vice versa, and the same thing for growth. With regard to break-evens, we haven't gotten that far because we don't have as much information and as much volatility. Break-evens have more or less been in an upward trend and steady. But again, what we're thinking is, for the most part, the information is in the tails. And now we have break-evens at a multi-decade high. We have reals off the lows, and so now that should be the focus. And that's going to be an indication of when monetary policy really starts to have, it really starts to infect the economy and really starts to show its teeth.
Chris, I had one Bloomberg subscriber just write in who would like to know what maturity you'd be using. Is one a better indicator than the other for what you're looking for?
Yeah. So a lot of people have different views on this. We're pretty simple. We look at 10-year break-evens. It's pretty stable. It's longer term, and we want that longer term stability. A lot of people will look at fives, and they'll look at various other issues. We simply stick to the 10-year because that's been a pretty good indication, a very stable indication of inflation expectations.
Chris, given this approach, are you de-emphasizing your index price target for year-end?
No, John, as we talked about, I think early in this year we said the equity market was going to break, right? This belief that the market can always bend but never break, that was a fallacy. That had to fall apart. That did. We came into this year, I think we were third lowest on the street at 47.15, right? We were the bull last year. We're pretty comfortable there because what we were calling for is a flat to down market. We don't see a recession. Right? So if we thought there was a recession, we might reevaluate, but we don't see a recession because there's not the same bad actors that you saw back in 01 and 08, right? The consumer, you can say as much as you want about the consumer, but balance sheets are good and they're in a pretty good spot. You can say what you want about corporations, but I don't see a WorldCom, I don't see things blowing up, and there's a lot of cash on the balance sheet. And the last thing I would say is banks have gone through the best stress test you could have ever designed for them. They went through the pandemic recession. And so we just don't see a recession materializing in the next 12 months. And with that, we're going to keep that 47.15. And we do think there's upside we're not bullish, but we think you can make money to the upside.
4,300 is a number that you've had in mind as well. Put money to work when we're below 4,300. Why is that number so important when we're at 4,250 right now, Chris? What's special about 4,300?
John, there's nothing special about that number. We were just saying we're looking for a 10% correction. At a 10% correction. When you get that 10% correction, you've taken a lot of froth out of the market. One of the things we also wanted to see multiple compression. We got that multiple compression. And at this point, if I said sentiment was bad, that's an understatement. Sentiment is horrific, and especially with growth managers. If you're a growth manager from the long-only side, you're down 20, 25%. This is not a good day. This is not a good year. And one of the things that we like to do is we like to go against sentiment. So at this point in time, it's not that things are great. It's just we think things are overdone. You've gotten rid of some of the excesses, and the underlying fundamentals are still relatively good for now.
Hard to read into the price action of the last 24 hours, Chris. In fact, the price action post-Fed has been pretty misleading. I'm thinking back to March 16th when we had a massive rally in the NASDAQ and then got absolutely hammered through the whole of April. Yeah. But what are your thoughts on what we've experienced in the last day or so? Do you think this was just trades coming off, shorts coming off, or longs going on? What was it for you?
Yeah, it's a little bit weird. I'm in a similar camp to you. Everyone was expecting a post-FOMC rally. And at first we got it, we didn't get it, we got it, we didn't get it. And then Powell came out and said, yeah, 75, not on the table. And the party started. Things just really rallied. What we saw is from the derivative side, we did see prior to this people putting on upside calls on the belief that I want to be careful if there is a pop. I think part of that was that. I think sentiment, as we talked about, is really, really poor. And so all you needed was a little bit more certainty. And what you got was a little bit more certainty, and you took some of the tail risk off. We can argue about whether it should be 3% or 2% or 1%, but I think it should have gone higher. Looks like as of today's action, it was a little bit too strong, and that's fair. But at the end of the day, I think you can now make money from the upside where I couldn't say that at the beginning of the year.
Let's see if that party continues. Chris, wonderful to catch up with you, sir. Chris Harvey there of Wells Fargo. We're about 11, 12 minutes into this. We are pulling back on the S&P by 1%, on the NASDAQ by 1.7%. Coming up, the volatility in big tech continues.
There's a very big dispersion in the U.S. tech stocks. You know, like you have a sort of mega cap tech, like a high quality names at the top of the index, which only saw some moderate correction so far. On the other side, you have what we call high beta tech, smaller cap typically, which are down 70%, 80% in some cases.
That conversation plus Elon Musk securing new financing for his Twitter deal. That conversation just around the corner with Dan Ives of Wedbush.
there's a very big dispersion in the U.S. tech stocks. Given all the uncertainty, we actually prefer stuff that is down a lot, So we think like if there is some relief, be it on inflation, be it on yields, you can have the high beta segment of tech rally a lot, Mega cap will probably do in line with the markets.
Marko Kolanovic there of JP Morgan, just building on his outlook for big tech and this market more broadly. On tech, Elon Musk bringing a new set of players into his Twitter deal, securing more than $7 billion in new financing and cutting his margin loan. Bloomberg's Taylor Riggs is back with us for more. Hey, Taylor.
John, I think what's interesting, you're getting a little bit of an increase here in shares, up 4%, but ever since that deal was announced, you've never really closed except for one day above 50. You had on April 25th at 51.70 a share, but we're not coming anywhere still close to about a 54.20. So trying to get there again today, and this would be near the highs that we've seen since that deal was announced. Let's dive deeper into some of the news that we got this morning. Of course, about $7.1 billion in new financing. Lots of investors, Binance, Brookfield, Qatar, friend and board member Larry Ellison of Oracle, as they're certainly bringing in some new partners, cutting down his stake, that margin loan to 6 from about $12 billion or so, doing some rounding estimates there for you, John, but you get the picture. I think what is interesting is, of course, since that deal was announced, you've seen that it's been that tight trading range. We're hovering between 46 and 51. Again, not even getting close to even $52 a share. We'll have to see what today's news brings as well. That further news, as you mentioned, maybe a co-CEO in the interim.
Taylor Riggs, fascinating to follow, that's for sure. Taylor, great coverage as always. Dan Ives says this over at Wedbush: bringing Ellison and others on board to help fund the Twitter deal is a smart poker move that will be well received by both Tesla and Twitter shareholders. Dan Ives joins us right now. Dan, can we start there? Why both Tesla and Twitter shareholders?
Well, for Tesla, if you look, Musk, in terms of leveraging his share in the overall ownership stake of Twitter, basically being financed on Tesla stock, taking less of a burden from Musk is a positive in terms of what he's ultimately down the road going to have to put up from Tesla stock. We also need the equity financing. He'll bring in partners, at least for probably 30 to 40% of that. So that's bullish because that's ultimately been about $100 per share overhang in Tesla stock. In terms of Twitter, because at this point, I'd say 75 to 80% chance the deal is going to get done. Now, probably 95% plus, because you bring in these partners, Ellison, Fidelity, Sequoia, and others. I think this just shows this was the missing piece in the puzzle for the street.
So you're highly confident he's got the financing now, Dan. What's the 10% that's left? What's the 10% of doubt you've got?
Look, I think you see just a little arb spread here. It's just there's going to be twists and turns from a regulatory perspective. I mean, obviously, this is going to get a big focus both in the Beltway as well as Brussels. There is some, there's only about $1 billion breakup fee, for him to walk away. It's small, but I do believe relative to today versus yesterday after this news, it feels more like this deal is on a glide path to get done. And I think it also just shows from a Tesla perspective, it's not just Musk trying to fix Twitter himself. I mean, you're going to have Ellison, Sequoia, and obviously Brookfield, Fidelity, and all these others. They'll have their teams, even though it's passive, called strategically help.
Yeah.
Because again, for Musk, the easy part was buying Twitter. Hard part's going to be fixing it.
Dan, this is the financing. Let's talk about the fixing and the management. CNBC reporting this morning that Elon Musk is expected to be the temporary Twitter CEO after and if this deal closes. Dan, what do you make of that?
Look, I think it's one that there was a good chance this was going to happen. I ultimately do believe that he ultimately moves more to a chairman role than not as a permanent CEO. I think obviously the fact that he's putting up basically 20% of his net worth, to buy Twitter, I mean, it's not a shock, but it also goes back that we saw with Dorsey and we've seen with others. Musk is the heart and lung of Tesla. So any distraction for him, I mean, that's going to be ultimately micro-analyzed in terms of just taking an eye off the ball. I believe he'll be able to manage it, but clearly you don't want to see him as a permanent CEO of Twitter.
Well, let's talk about whether he would be. And if you've got a decent picture of what he's going to do with this name, it's been widely reported, and most people speculated that once it went private, it wouldn't be too long before it became public again. Dan, have you got a decent idea for the trajectory of how you think this plays out, the timeline for it?
Look, I think this is going to be an Everest-like uphill battle to fix Twitter. I mean, remember, relative to also what he's paying, no one's going to get within, a football field of that price relative to the 54.20. He's going to have to transform it. It's going to take years, 2 to 3 years, subscription model, the advertising, the algorithms, the free speech. That's going to continue to be a tightrope. Social media arms race, Twitter has basically been in the right lane missing out where others pass him in the left lane. So I think this is going to be uphill battle. I would not expect this to get back out in the public markets for a number of years.
Dan, Taylor Riggs mentioned earlier, and she's right, that Elon Musk has proven that he can manage several different companies. He's had success with many of them. Tesla, of course, first and foremost. Can you tell me, as someone who covers Tesla, when all of this starts to become a little bit more problematic for you, are we there yet? If we're not, what would it take?
Yeah, we're not there yet. And I think Musk, the golden child for Musk continues to be Tesla. But between the build-outs of the Giga factories in Berlin and Austin, and of course what's happened in China, potentially a second factor there, you got autonomous FSD, Cybertruck. I mean, there's a lot on the plate in terms of Tesla. John, I would say if we go into the next, call it 12, 18 months, and you start to maybe see some hiccups, tripping over the shoelaces type things that happen at Tesla, that's where you start to get concerned. But as we know, I mean, he's had the golden touch. It's hard to ultimately bet against him. And ultimately for Twitter, I mean, this has been a treadmill stock for the last decade. So clearly he's going to improve it right off the bat. But it goes back to the easy part was buying it. The hard part is going to be fixing Twitter. It's a whole different animal than the technology companies of Tesla, SpaceX.
Dan, final word. I've got 30 seconds for you. April was a really tough month for you, and you've been open and transparent about it. Difficult. Run me through what you learned from the month of April, just as far as some of how these tech stocks traded, and what you're thinking going forward.
It's been a brutal month. It's been a brutal year. I mean, for any tech investor bull like ourselves. Look, I think it's a have and have nots during earnings season. I mean, enterprise, cybersecurity, cloud, demand for names like Apple, semis holding up strong. But it goes back to the work from home names, the e-commerce. Those are going to continue to sell off, and won't really touch any of those names. I think you got to own quality tech. I still think what we saw with Powell, that's starting to put the bottom in tech in terms of what we see oversold. But no doubt, it has been. It's been a year so far where I think it's going to drive many to be drinking a lot of wine.
Don't do that, Dan. Stick with us. Stay sober. That's where we need you on TV. Sober, not drunk. Dan Ives of Wedbush. Dan, great to catch up with you, buddy. As always, your trading diary up next. Well, yesterday giveth, today taketh away, something like that. I've butchered that, haven't I? You get the picture. We're taking yesterday back in a big way on the NASDAQ 100, down by 2.6%. That's the price action. Here's your trading diary. Payrolls report tomorrow morning. A host of Fed speak, including Williams, Kashkari, Bullard and Waller. Inventories next Monday. Fed speak, more of it Tuesday. CPI on Wednesday. That's the big one we're counting you down to after payrolls tomorrow. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Thursday, May 5th. Here are the top market stories we're following for you at this hour. Recession risk. The Bank of England raises interest rates by 25 basis points to 1% as it warns it sees a risk of recession in the U.K. as inflation remains above 10%. That comes just one day after the Fed's first 0.5% rate hike in 22 years. And risk off. That has markets trading with a risk off tone as stocks pair gains seen over the last 3 days and the pound weakens against the dollar. Cable trading with a 123 handle.
Sticking to the plan, OPEC and its allies ratified the standard 432,000 barrel a day increase in its third 13-minute meeting since the war in Ukraine began, even as the EU aims to ban Russian oil, while the U.S. eyes more oil purchases, crude rallying on the back of those announcements. From New York, I'm Kriti Gupta with Guy Johnson in London. Alex Steele is off. Welcome to Bloomberg Markets. Guy, a historic couple of days, but I got to say the BOE, it takes the cake this morning.
I don't know what to say about market reactions. I don't know what to say about central banks. I am absolutely flummoxed by all of this. The market reaction to what we're hearing from central banks, the central banks, what did they expect to happen? Maybe not what we're seeing in the markets. We've got a lot to work our way through. A couple of pieces of breaking news that I think are worth focusing on. Alex Steele, if she is watching, has a huge smile on her face right now. US mortgage rates jumping to 5.27. That's the highest since August 2009. Alex Steele managed, I think, to pick the bottom in 30-year rates for mortgages in the United States. She will be back on Monday, and I expect that she will be talking about that a little bit. The other thing that's worth mentioning as well is the US Treasury, the US 10-year, US 30 years up really quite sharply now. The US 10-year now trading well north of 3%. We are up by 9 basis points. There has been a significant spike higher in yields in the United States over the last hour or so. This is, we've seen a significant move lower in UK yields over the last few hours. I don't know what the answer to our question of the day is, because I don't know whether or not we should be focusing on growth or whether we should be focusing on inflation. The market, I think, can't make up its mind either. Are we past peak hawkishness? Are we at peak hawkishness? As Cameron Christ says on the M Live today, it could be a plateau, Table Mountain, rather than a traditional kind of V-shape up and then down. I'm trying to think of another mountain that we could potentially use. Think Kilimanjaro. Stick with the Africa theme. So where are we? Which one of those should we be focusing on? Are we at peak hawkishness, or should we be continuing to focus on inflation rather than the growth narrative? Mike McKee, Bloomberg's international economics and policy correspondent, joining us, as is the one and only Vincent Signorella, Bloomberg macro strategist. Mike, what do you think to the answer to this question? You were in the room with the Fed yesterday. You talked to the Fed. I've just been talking to the governor of the Bank of England. What is your sense of where we are? Is this peak hawkishness? Is it downhill from here? Or should actually we be refocusing on this inflation narrative?
Well, I think you need to refocus on the inflation narrative. When you look at what is happening to oil prices the last couple of days, the headlines are going to go up, especially as Europe moves towards an embargo of Russian oil. We're going to see more expensive energy, and that is going to hurt in terms of inflation. But when you're thinking of it from a central banker's point of view, you want to look at the core rate, because there's nothing they can do about oil or about food prices that are going up. And so as we watch the indicators going forward, let's see if there are broader price pressures that continue, or if those start to slow a little bit. It's hard to know about peak at this point. I'm envisioning clouds around the top of the mountain, and you don't know exactly where the peak is.
Yep.
That's quite the visual. Let's bring in Vince Signorella here. Vince, hop into this conversation. Are we past peak hawkishness? Because there are two issues here. There's inflation, there's growth, and if the BOE is perhaps a crystal ball for any other central banks around the world, you're seeing some very aggressive hikes and commentary coming in the face of lower growth forecasts. How is the world's central banking leaders supposed to square the two?
First, I would caution not to look at the Bank of England as an example. We can recall what they did during the pandemic by panicking in terms of cutting rates and then having to panic back and raise rates. I think Mike makes a good point about the cloudiness of the issue and what the Fed can control and what the Fed can't control. I think realistically what we're seeing is almost a panic reaction in markets regarding inflation. Yes, prices are going up. Yes, mortgage rates are higher. Yes, wages are not exactly keeping pace. But you're looking at a 5.25% 30-year mortgage rate. You're looking at a 3-odd% 10-year yield. That's far and away from where we talk about panic inflation of 40 years ago. 40 years ago, we had 10-year yields up towards 13%, and we had mortgage rates above 17%, just to put things in perspective. So yes, things are going up. We're not past the hawkish sense of it just yet in terms of a peak, only because the markets are continuing to panic. I don't think
do you think this is the new environment we're in? We have been, since 2008, we've been in an environment where effectively central banks, particularly the Fed, but others as well, have effectively guided the markets, put the markets to sleep. Everybody's been anesthetized by what has been happening. We are now in a world where I'm not sure central banks really have a handle on what is happening, and that is being amplified into the markets. And as a result of which, we may be entering a period that is not going to be short. It could be quite an elongated period in which nobody really understands what is happening, and as a result of which we're going to get days like today when we see huge amounts of volatility around key assets.
Yeah, I mean, I'm looking at the Dow now down 550 yesterday. The futures closed up over 900. I mean, volatility is definitely here to stay. Don't get me wrong. But what the central banks are doing is potentially making another huge blunder by rushing too quickly to raise rates. If the market wants to raise rates, let the market raise rates. The Fed is just following suit. There's nothing they can do about it. They're not, as Mike said, they can't control energy prices. They can't control food prices. Raising rates too aggressively only potentially stifles economic growth, which puts them in a situation of stagflation. They can only make a huge mistake at this point. They cannot lead markets. Markets lead the Fed. This idea that the Fed leads market is a result of Greenspan, which in my opinion was absolutely just, well, never mind. In thinking that he could tell the markets what to do is a complete joke. Central banks don't tell markets what to do. Markets tell central banks what to do. And in this, the current thinking is that central banks are telling us what to do is actually incorrect. The rates are going up and the Fed is chasing. Rates went down, the Fed chased. This is the same situation. Rates are going to go wherever the market thinks they're going to go. And if the Fed overreacts, all they're going to do is make the situation worse.
Mike, hop into what Vince was just talking about, because a key part of that press conference we heard from Chairman Powell, something that stood out to me was he said monetary policy to a large extent is working through expectations. Would you agree with Vince's take?
Not quite. Here's the reason why. You have an awful lot of Fed speakers who have raised possibilities, and I'm thinking and looking at you here, Jim Bullard, of ever more hawkish Fed actions that then the market adjusts to. And I'm thinking that Ira Jersey, our Bloomberg Intelligence fixed income guy, said yesterday he thinks that the Fed is front-running itself. And to a certain extent, I think that's true. They're putting out there the possibility of doing all these extra hawkish things that they may not follow through on, but the markets are repricing to them, especially the 75 basis points idea that nobody really endorsed, not even Bullard. He just brought it up as a possibility, and yet we saw the reaction yesterday in the markets where everybody said the biggest increase in the Fed funds rate since 2000 was dovish because it wasn't worse. That strikes me as kind of odd.
Yeah, Mike, does the Fed, does the Bank of England, does the ECB have to adjust now to a new world in which their words carry extra weight? As I said before, we've been through a period where basically markets have been anesthetized. Therefore, the amplitude of the reaction, the size of the reaction you get from any given phrase or word was smaller. We now seem to be, because everybody's so confused, that the words seem to carry even more weight. Are central banks talking too much?
I don't know if they're talking too much. You can't really tell these independent members of these monetary policy committees that they're not allowed to speak. They're designed to have a variety of voices. But I do think that there is a sense of uncertainty that is greater than we have seen in years. I mean, when we had the tech bubble pop and then the Fed started raising rates and they did 25 basis points for 17 consecutive meetings, that's gone. And the markets don't know any more than the Fed or the Bank of England or the ECB what they're going to do and when they're going to do it. And so the markets are going to be much more volatile, much more jittery, and the Fed and the other central bankers are only going to feed into that. I do have one suggestion for you, Guy, for your viewers. Maybe you hold a contest because stagflation doesn't work for England. For the United Kingdom, because if you're going to have a contraction and rising inflation, it's not stagnant.
No. To be fair, actually, if you look at the specifics, they're not necessarily calling for a recession, but
But yeah, I take your points. Basically, we've got negative growth and very much not negative inflation. I just wonder whether the market is focusing on one to the detriment of the other. We're going to hear from the governor of the Bank of England. I just sat down with him. I have to say, we started the conversation talking about the market reaction. He seemed a little surprised. Anyway, we'll bring you that a little bit later. Mike McKee, Vincent Signorella, gentlemen, thank you very much indeed. As I say, in the next hour, we're going to bring you my conversation with the governor, Andrew Bailey. My first question, are you surprised? I gave him the market reaction. Are you surprised? We'll talk about it. We'll talk more about this in the second hour. BlackRock's Gargi Chowdhury is going to join us next. We'll continue the conversation around these central banks. That's next. This is Bloomberg.
April jobs are in focus.
It's a very, very good labor market for workers. The demand for labor, obviously, much stronger than the supply.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
As long as the numbers hold up, the Fed is going to feel encouraged.
Then 75 in June is certainly not out of the question.
To me, the question is, are we fully employed?
The elephant is the war in Ukraine.
The April Jobs Report, Friday on Bloomberg Television and Radio.
Back to our question of the day. Are we past peak hawkishness? Joining us now, Gargi Chowdhury, head of iShares America's investment strategy at BlackRock. Thank you as always for joining us. A historic moment when you look at whether the Federal Reserve or the BOE this morning. Two main issues, inflation versus growth. Are we past peak hawkishness? Your take.
Good morning. Thank you for having me. So I'd say for this week, yes, we are past peak hawkishness. I think the market breathed a great sigh of relief when we learned from the Fed that at least the 75 basis points was off the table for now. They're not actively considering it. And that we were given very clear forward guidance around the next couple of meetings being 50 basis points. So I would say for now, we are, but that doesn't mean that the data that's going to come over the course of the month, whether most importantly, the data on inflation, will not lead us to price in further rate hikes. Again, more 50 basis point rate hikes. I don't think we're going to get to a 75 basis point rate hike again anytime soon.
The market reaction to both the Bank of England and the Fed, I think, is fascinating. The market reaction to the Fed was, as you say, relatively restrained in as much as, well, the Fed is going to be relatively restrained, and that seemed to be the green light for stocks initially. Now, stocks are rolling over now, and yields are starting to spike a little bit higher. The Bank of England, despite putting out a double-digit inflation forecast, was taken as dovish because, well, growth is going to be a problem. Gargi, does the market have a good sense of how to read central banks right now?
You know, I was listening to the conversation that you were having with the speakers that came on before me, and I think that the market is trying to determine what is the most important factor going forward. So for the Fed, it's very clear. They are a single mandate Fed right now. They are only focused on inflation, and they're telling us that. They told us that in numerous ways yesterday, that till they see the signs of inflation turning over, they are likely to continue to raise rates into sort of neutral territory. And we can discuss later a little bit around their definition of neutral, which I thought was interesting. I think that right now the market isn't any more or less sensitive than any time in the past, but I think there's this unique nature to inflation, which is so supply driven. And, you know, to Chair Powell's point yesterday, they don't really have the tools to navigate supply driven inflation. So therefore, I think the market's having a harder time, you know, just the moves that we've seen over the last couple of days, deciphering which to focus on. And I think inflation is top of mind broadly across ECB, across Bank of Japan, across BOE, and obviously the Fed.
Gargi, I have to ask you about the currency market. We've seen volatility across markets, but the currency market has really been something extremely unique. That dollar strength picture, you've seen continuous weakness in the yen and in the euro, as you know. You're also seeing weakness in the pound today, looking at 123 on the cable rate. Over at SocGen, Kit Juke says the likelihood of the cable rate dropping below 120 is larger than euro-dollar parity. Would you agree with that?
So I think, you know, to your point, obviously there's been a huge move in the dollar this year. You know, we see within iShares, which is where I work, we're seeing a huge amount of interest in sort of hedged products, especially in Japan yen hedged products. So I would say that investors are pushing back, or at least recognizing that maybe a little bit of value is being created at these levels of the yen right now. And look, our view is that at least in the front end of the curve. So when we look at the 2-year, the 3-year part, I think we're beginning to get at levels that offer a lot of value. Does that mean that the dollar is going to immediately move significantly lower? No, but I do think that at some point we have to come to terms with the fact that more of the move has happened, especially in the front end of the curve. And at some point above 3% on the 10-year Treasury, I think we are probably going to see a little bit of buying come in the fixed income markets as well.
How can we know where we're going if we don't yet fully understand the implications, Gargi, of what is going on in the labour market? The labour market in the States, the labour market here in the UK is unbelievably strong. Until we start to see data suggesting that maybe we're going back towards balance, can we really get a handle on how far these central banks are going to have to go?
I think we heard a little bit about that yesterday, right? So I think this is exactly the point that Chair Powell was trying to make, and I think he did an excellent job of it, where he said that they don't have a specific, VU ratio in mind, so vacancies to unemployed ratio in mind. He talked about that 1.9 number a few times, but it's not as if he's targeting a 1 or a 1.2. What we should be focused on going forward is, looking to see if more and more people are enticed back into the labor market as a result of higher wages. And obviously we'll get a reading of that tomorrow when we get the payroll print in the morning. But I think that as of right now, what we should be focused on is higher wages, allowing more people to enter the labor market at hopefully levels that, increasing the participation rate. Hopefully we'll see some of that, and wages still remain steady. So I don't think we'll have a clear sense of how quickly that's going to happen happen. I don't think we're going to have a clear sense very soon around what that V2U ratio is going to look like. But I think if we focus on a few things, if we focus on the participation rate and not just on the headline number, I think tomorrow we may get a slightly weaker than expected number, but let's not get panicked about that. I think we should look at the underlying strength of the labor market, which, hopefully participation will show us that. And obviously keeping the JOLTS backdrop in mind. How many people or how many jobs are still available for workers? How many people are quitting their jobs? And to what extent that portends a really robust labor market?
Yeah. Certainly the JOLTS number looked pretty strong. I know it's a rear-view mirror number, but it is in some ways forward-looking. One would appear maybe to cancel the other one out. Gargi, thank you very much indeed. It's going to be a fascinating payroll report. Gargi Chaudhry of BlackRock, greatly appreciated. Coming up, what are we going to talk about next? Twitter, I think, probably is where we should go. Elon Musk lining up some big names to invest in his $44 billion Twitter deal. Details to follow. This is Bloomberg.
This is Bloomberg.
Brookfield Assets VC arm cuts its largest check to date to help finance Elon Musk's Twitter purchase. Other backers include billionaire Larry Ellison and Saudi Prince Al-Walid bin Talal, agreeing to roll over his current investment. For more, let's bring in Mandeep Singh of Bloomberg Intelligence. He joins us now right here in the New York set. Mandeep, let's start off with some breaking news with Twitter in particular. Reports suggest that Elon Musk is going to be, at least temporarily, the CEO of the social media company. What does that do, if anything, to its bottom line?
Well, so clearly he has a plan and he wants himself to execute it. And I think his focus is really towards cutting costs, because he does think, the EBITDA margins for Twitter are much lower than their competitors. So clearly there will be a focus on costs. And with the new investors joining him, look, I don't think there is a panacea when it comes to turning around the top line growth for this company. So it will take time, and looks like all these investors are ready to wait for a while, as opposed to private equity players like Apollo or Thoma Bravo, who may have looked for a 3 to 5 year exit.
Mandeep, is this a zero-sum game? If he's CEO of Twitter, what does that leave for Tesla in terms of time and attention?
Well, that was the biggest criticism with Jack Dorsey running two companies, right? Square and Twitter. And so in this case, clearly you could make the same argument. The difference is Twitter will be a private company going forward. And I'm sure, the likes of Andreessen Horowitz or Sequoia will play a part in terms of running the day-to-day operations of the company.
Mandeep, Twitter shares up 3.7%, trading still below that 52.40 or 54.20, excuse me, offer price of Elon Musk. We're looking at about $51, let's say. I have to ask, why is he suddenly getting all this financing? Because when he first introduced the deal, he was having trouble finding the backers. What's changed?
Well, so we still don't know the remainder of that 15 to 20 billion. So look, he arranged the 7 billion, right. And he lowered the loan component, but there is still 15 to 20 billion. Is he selling stock? What does it do to his overall portfolio, and stake in Tesla stock? So there's still some unknowns. Looks like there won't be any new partners from the private equity side. So he may have to sell stock to really get that remainder of the 15 to 20 billion.
When do you think we're going to start getting clues as to what Twitter 2.0 is going to look like?
Well, we are getting clues in the sense that he thinks subscription is a better way to monetize Twitter's engagement, and he has tweeted about, the commercial users paying a subscription fee. It will still be freemium for the common user, but I think he's leaning towards subscriptions, and that's a dangerous thing because all the social media players currently pivot to an advertising model, so it remains to be seen whether subscription can turn out to be a big bet in the social media space.
Great stuff, Mandeep. Thank you very much indeed, as ever, for the analysis. Mandeep Singh of Bloomberg Intelligence. Right, coming up, still plenty of snags in the global supply chain story. Companies continue to struggle to manage inventory. There's interesting things happening in fast fashion. Chief Investment Officer at GXO, Mark Manduka, next. This is Bloomberg.
We're an hour into the U.S. trading session. Bloomberg's Ritika Gupta is tracking the moves. Ritika.
Yes, Chrissy. Well, how quickly things change. That's what I just want to start on here, because yesterday you got that big relief rally, the S&P 500, the NASDAQ having their best day going in about 2 years, and actually their best Fed day since all the way back to 1978. You can see we move lower pretty aggressively here. Perhaps that rally was a little overdone. Yes, 75 basis points maybe off the table, but you know what? The fundamentals haven't really changed here. You still got 50 basis point hike. That was the largest going back to 2000, and more 50 basis point hikes to come. And you kind of see that in move reflected in the 2-year yield today. Of course, that's kind of the market expectations for where monetary policy is going. That's moving back higher again. Yesterday, you saw that 2-year yield down some 14 basis points, but today continuing that trajectory higher. And what is also continuing that trajectory higher is indeed oil. So yesterday, that moved 5% higher. The EU planning to phase in that ban of Russian oil. And today, that OPEC Plus meeting, that yes, they went ahead with that moderate hike in output as expected, but there are questions whether that supply will even reach. Now let's shift tone a little bit here, because one of the other many themes today is those e-commerce stocks had some disappointing earnings out, and that disappointed investors in a big way. That was after Amazon, that historic rout we saw last week with those revenue forecasts missing analyst estimates, really highlights the shift in tone as consumers get back out there and shop. So some trends changing from the pandemic, and those macro headwinds of inflation as well weighing on some consumer spending. Let's take a look at some of the movers under the hood in that space. You have Wayfair down in the double digits, down some 18%. Those actually reporting an adjusted quarterly loss. The CEO also announcing a retirement. Then I take a look at Etsy here, also down in a big way. They actually did beat in their latest quarter, but it was that outlook, that forward guidance on missing those revenue expectations. Again, those macro headwinds and the changes as consumers get back out there. It was a similar story over for eBay, but I will leave you guys with one mover to the upside. Take a look at Albemarle. This is a miner for lithium, getting a big rise of 9%, beat in those earnings. They have a lot of pricing power. Analysts very bullish about this stock, as of course we see that demand for EVs just go higher and higher. Chrissy, Guy.
Ritika, thank you very much indeed. Bloomberg's Ritika Gupta on what's happening in these markets. Let's talk about one individual stock within these markets. GXO is currently tracking around 4% lower. The company, though, has raised its full year guidance. Reported the first quarter revenue rose 14% from a year earlier. It's raised its revenue guidance to 11 to 15% organic growth in 2022. That sounds like a pretty positive picture, yet the stock, as you can see, is over 2 days only down by 0.2%, but on the day down a little bit more. Let's talk to GXO's Chief Investment Officer, Mark Manduca. Mark, these are numbers that at first blush look pretty strong, and certainly your guidance feels pretty strong as well. What is the market not getting about the GXO story?
I think your point about high growth is well made. I think even on a second blush, these numbers are very strong indeed, Guy. The reality is that we've entered a period, or exited a period rather, over the last 6 months where everyone's been indiscriminately selling everything. And what I think is going to happen over the next 6 months, testament to what we were saying on our conference call this morning, is that we're going to get some discrimination between the good and the bads that we've just heard about. I think we're going to get a period here where people start to focus on brands with pricing power, people who can pass on inflation, and there is going to be an element of differentiation now that takes place. So the market will do whatever the market will do on a day-to-day basis, but we're very focused on the fact that we've just done 19% organic revenue growth. We've got a $2.5 billion pipeline, and we're growing EPS this year by 29 to 39%. I've got customers falling over themselves wanting to do business with us, and I wake up every morning feeling like I'm holding onto the tail of a tiger, quite frankly. So times are good.
Mark, it's Kriti in New York. Let's talk about some of the challenges of the future. When we're talking about exports, a lot of concerns coming around China right now, the COVID lockdowns there, but also can the exports leave China? Can the exports leave Germany? A lot of those pre-war supply chain issues and inflation issues, they're going to stick around. What does that mean for logistics broadly?
I think there are lots of problems out there, Chrissy, and you and Guy and I have spoken about this a lot. Now, the reality is, if you look at the world right now, about a fifth of the world's container ships are under some form of berth sitting outside a port. So there's a lot of bottlenecks out there. If you look specifically on your point of Asia, I mean, if you look at Shanghai specifically, we've got around 344 container ships stuck outside the port of Shanghai. These bottlenecks are not going away anytime soon, particularly with the zero COVID policies and what's happening, of course, in the air freight market over Russia. There are going to be constraints in this market for a while. And really, the theme that's going to prevalate here, I think, over the next 12 to 24 months is what you're going to see is that people are going to continually nearshore. They're going to make decisions where they put their warehouses. It's going to be less Asia, more in the West. That requires a decision-making process, and those are kind of the calls that I'm getting at the moment. Customers are coming to us saying, I want to be closer to our end consumer, but be very clear, supply chains are going to be a theme for the next 12 to 24 months. The problems aren't going away anytime soon.
Mark, can we just talk a little bit about what the consumer is doing right now? You are in the e-commerce business, and I'm wondering what you're getting back from customers. I'm not asking for specifics here, but I'm asking for generalities. Today, we are seeing the e-commerce giants getting hit and hit hard on the S&P. Etsy's one of the biggest decliners out there. Wayfair also down pretty big. Here in the UK, Boohoo down. Zalando in Germany also over the last 24 hours taking a very big hit. What are you seeing in that kind of fast fashion e-commerce market right now? The stocks have held up reasonably well thus far. What do you see in these businesses?
If I look across the entire consumer and industrial space that touches e-com for us, I'm seeing strength, but I am also seeing in parts a bit of softness in some of the areas such as automotive, which is less e-commerce focused. But particularly if you look at consumer, fashion, very strong indeed, to your point, Guy. I think overall what surprised me is the consistency of, despite the fact that we've had this shift from, as you said earlier, with Ratika's comments, from e-com into brick and mortar retail, the reality is that both e-com and brick and mortar retail have remained resilient through the first quarter. That's really underpinned that 19% organic growth that I've talked about. I think there is a bit of a differentiation here in terms of the haves and the have-nots, and I think that's going to be a bit of a barbell into the second half of the year. But consumer elements like fashion remain strong. Places like the industrials, a little bit softer, but overall, across my portfolio, I'm seeing strength when it comes to consumption.
Well, those consumer sectors that you just mentioned, fashion, for example, those supply chains extend into Asia. You mentioned earlier the concept of nearshoring those supply chains. I'm curious about your forecast for perhaps countries like in Latin America, for example, moving production from China to Mexico when it comes to American consumption. What are your thoughts?
There's a lot of demand, as you know, for warehousing in Mexico right now. It's the right place at the right time with the right currency. We're seeing also huge demand for shifting back towards the US market for warehousing. We're also seeing strong demand on the continent as well. And this is really one of the reasons we're seeing wage inflation. If you look at the piece across the European and US market, wage inflation is tracking at the moment across our business anywhere between mid to high single digits in the US and low to mid single digits across the continent in Europe. But there is huge demand for warehousing. Prologis mentioned it obviously on their call a couple of weeks ago. That's not a theme that's going to change anytime soon. Mexico, US, continental Europe is seeing strong demand for warehousing.
Mark, let me talk about our question of the day and slightly rephrase it. Which aspects of the economy should the market be focusing on right now? Inflation or growth?
I love it how you always ask me to play market strategist. It's very kind of you, Guy. I think it goes back to this idea of the fact that Wall Street has benefited from inflation, asset inflation specifically, for the last 10 years. And we've all become accustomed, particularly market strategists who are wet between their ears. They're basically seeing a lot of things that point them towards buying utilities and buying dividends. And therefore, there's this obsession with the fact that there's a shift from Wall Street inflation now to Main Street inflation. The fact that I said to you that wages have been going up for the last 12 months. And Wall Street's a bit flummoxed about what to do with this. They don't quite understand what to do. What it means for me is that you're going to see winners in the brand space that can pass on pricing to their end consumers in the second half of the year. Those are the stocks that do well. Businesses such as mine, where there's an inflation pass-through, and businesses that have underlying growth stories that go beyond COVID. My total addressable market is $430 billion. I've got tons of growth ahead. That's the differentiation that we're going to see here. And inflation is going to play a narrative behind that. Guessing about a recession in the second half, I still think is the great unknown, but inflation is here and now, and that's something that you can invest behind.
Mark, I want to talk about the currency story with you. In a past life, I believe you were a market strategist, so we're going to put that hat on for a moment. When we're talking about the Federal Reserve here, you're also seeing some pretty extreme dollar strength, weakness in the rest of the world. You hit on the currency picture for Mexico. I'm curious about the implications of that dollar strength on the supply chain business.
I think it's fascinating what you say about the way that the supply chains are changing in regards to currency. There seems to be this tug of war going on from everything from the Federal Reserve all the way through to the Bank of Japan about how they want to play the interest rate cycle and how much you want to forgive on your currency. I don't see that changing anytime soon, and I think it definitely drives warehouse decision making. I think it drives employee decision making as well for this business. But it seems like that dollar strength is going to continue from here on out.
Where are you seeing supply chain issues, Mark? I've been to some of your facilities. You use robots, you use a lot of robots, and increasingly you're going to use more of them. Talk to me about how that side of the business is evolving as we see this tight labor market.
I think you've hit on it with that last point, which is labor availability has been the big issue for businesses such as ours. And the way that we've combated that and dealt so well with it over the last 12 months, we've got 300 HR executives poring over every single one of the business parks that we operate in across the US market. So it's really being about granular detail here, Guy, making sure that you know exactly what the fair competitive wage is within the various business parks across the US. So we've really focused on that detail. But I also feel that there's an element here of making sure that there is softer pay and play, making sure that you're looking after your employees in the downtime sessions, lunches, dinners, making sure that you're giving them proper career prospects. That's what we really focus on in this business, and I think that that's going to be a big theme. We're going to see a differentiation here between companies that have really got their HR fingers on the pulse and companies that don't, and I think that that's going to be a theme over the next 12 months.
Mark Manduca, GXO Logistics CIO, thank you so much as always for joining us. Coming up, oil jumping to its highest since late March after a report that the U.S. plans to put out bids to replenish reserves. More on that and the OPEC Plus output deal. That's coming up next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. The Bank of England has raised interest rates to their highest level since the financial crisis. Plus, it warned the economy is on course to shrink under pressure from double-digit inflation. The quarter-point rate increase to 1% was backed by 6 of the bank's 9 policymakers. The other 3 wanted a half-point rate hike. The coronavirus death toll probably climbed to almost 15 million people in its first 2 years. In other words, about 1 out of every 500 people worldwide. That's according to the World Health Organization. The new estimate is actually more than twice the figures from individual governments' reports. And OPEC and its allies once again agreed on a small monthly increase in production. It comes at a time when global markets are likely to get even tighter because of EU's proposed ban on Russian oil. OPEC Plus ratified a 432,000 barrel a day increase. Analysts doubt the alliance will even be able to deliver that much. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Guy.
Rika, thank you very much. I want to come back to that OPEC story in just a moment, but let's talk about what is happening in other assets right now. The Nasdaq is falling like a brick. It's down like 4% now and continuing to fall. Maybe flying like a brick would be a better way of putting it. The 2-day chart obviously doesn't look quite so brutal, but it is down and down hard. It's now down by 3%. Sorry, it was down over 4%. So we've recovered a little bit in the last kind of few seconds. But nevertheless, this is a market that is under significant pressure after rising rapidly. I think the 2-day chart is the one that maybe we'll get the producers to put up because basically we've completely round-tripped around that Fed meeting. Perceived as dovish. Nasdaq goes up, falls rapidly today as we refocus on inflation. The US 10-year is up by 10 basis points. Oil is trading higher. Like a little bit, but it's trading higher. Let's talk about that OPEC decision and get a sense of whether or not OPEC really kind of is in control of anything anymore. Will Kennedy, Bloomberg's executive editor for energy and commodities, joining me now on set. So as expected, a little increase, pretty much in line with what we've seen before, but to be honest, OPEC's ability to actually deliver on that increase being questioned. Does OPEC have any control over the oil price anymore?
It's decided to sit this one out, I think it's fair to say. What's important here is that since the war in Ukraine started, we've had all sorts of convulsions in the global oil market, and OPEC has stuck exactly to the plan it had from before the war started. So for several reasons, it's not engaging. It is raising production, but very slowly. And as you say, Guy, it's not even delivering on those promises. Now, the UAE and Saudi Arabia still have some spare capacity. They could bring more oil to bear on the market. The White House would dearly love them to do that. But they've decided that the unity of the alliance, which includes Russia, of course, is more important. And for them, it's prudent just to continue doing what they were doing.
Well, this has been the third 13-minute meeting since the war in Ukraine began. A couple months ago, I spoke to Nigerian oil minister after that first 13-minute meeting. He said, we're still kind of monitoring developments. Well, it's been a couple of months now. I'm curious how much of this decision is a reaction to the supply-demand situation as opposed to some of these OPEC members actually being able to meet their quotas, Russia included.
There is a bit of that, and of course Russia's going to be in a difficult situation with OPEC Plus because clearly Russian production is falling fast now, likely to fall more if the EU enacts the embargo it proposed yesterday and its sanctions on shipping, and it won't be able to get anywhere close to its quota. But there are two things that mean that the market is actually relatively subdued compared to what it might be, and that's probably giving OPEC some room to carry on doing what it was doing. Oil demand is very subdued in China because of the lockdowns that we've seen in Shanghai and rolling out over other parts of the country. We estimated a couple of weeks ago that demand was probably taken at least 1 million barrel hit from that. And also we have the Biden administration's decision last month, or in late March rather, to release 1 million barrels a day from the strategic stockpile. So both of those things are keeping a lid on prices. Yes, we're high, we're well above 110, but we're a long way from the 139 we saw in the weeks after the war. And I think that's allowed OPEC some space to carry on doing what it planned to do without getting too much criticism from elsewhere.
At what point do we see that SPR release effectively being counteracted by the administration's plans to refill the SPR,
well,
which they're starting to announce now?
Yes, there's a story today that they're going to put out a tender in the autumn, in the fall, to start buying back some of that oil. 60 million barrels compared to the 180 million barrels that they plan to release, so it's not all of it. I think we need to see some more details exactly when. It's likely to be that tender will be for oil that doesn't get bought until 2023, perhaps even 2024, 25. So it's a slow, long-term process. I think the market may have got a bit overexcited about that headline.
Well, in the macro sphere, we're talking about persistent inflation, a lot of which is driven by these higher energy prices. Gasoline, diesel, for example, extremely high right now. How high is the expectation, or how long is the expectation of oil, that oil will remain over $100 a barrel? Are we talking months, years, a decade?
There's no reason to think that it would fall markedly from here absent a really dramatic slowdown in the economy, perhaps a recession and a knock-on effect on demand. But I think it's important to say, Kriti, that we're not seeing that. We had Shell announce record profits today on the back of these high oil and fuel prices. And the CEO in a call with analysts said that they are seeing no sign that these high prices are causing any sort of demand contraction. We can see that people are driving, people are flying, the economy is still working fairly fast, keeping diesel. So the economy at the moment is absorbing these very high prices. The real question is how long that lasts and whether we do get demand distraction later in the year. But it's important, I think, that the Shell CEO, Europe's largest oil company, said that there's no sign of that yet.
Bloomberg's Will Kennedy, we thank you so much as always for your insight. Let's get a quick check on these markets though, because the sell-off really is getting worse and worse. The S&P 500 down 3.1%. You're looking at the NASDAQ where a lot of that pain is concentrated in those e-commerce names. The index as a whole down 1.2%. This comes in tandem with this yield move, the 10-year yield. We're looking at an 11 basis point move, crossing that 3% threshold. We're looking at 304 basis points on the 10-year yield. And dollar strength continues to be the story. You're looking at a 103 handle on the DXY. I'm looking at it bouncing up against these key technical levels in 2014, 2016, 2020. How much of this is really a read-through from the Federal Reserve? We're going to have all those updates for you throughout the hour. Stick with us. This is Bloomberg.
So there's quite a lot going on right now. So let's talk you through the price action because the last 24 hours have been absolutely amazing. I'm going to start with the US, then we'll talk about Europe. Europe in some ways has missed out on all of this. So yesterday we get the Fed. Powell puts to bed the idea of 75 basis points. The market reacts really strongly. The Nasdaq shoots higher, yields shoot lower. Today we're completely reversing that. The Nasdaq is now flying like a brick. It's basically gone up and has gone down, almost ballistically. Kind of looks like that, a ballistic curve in what we're seeing. The Nasdaq is now down by 4%. I think we're actually below where we were pre-Powell yesterday. So we're down pretty sharply. 4.2%. The US 10-year is up sharply. So we're refocusing basically on inflation and pricing back in the idea that actually rates are going to go up and go up aggressively. That didn't take long, did it? The dollar is definitely catching a bid. You got a 103 handle on the dollar index. We're trading up by around 1%. So that's the picture stateside. In some ways, and we're approaching the end of the day here in Europe, Europe has just basically sat all this out. We were closed by the time we got the news from Powell yesterday in the press conference, as a result of which we didn't really have to deal with it. So we got the way up and now we're getting the way down. So actually kind of from where we started, Europe really hasn't changed very much. And you can kind of see that being reflected in the market. We are trading those sub 440 on the stock 600. The Bank of England has been the main story over here today. Just mass confusion, I think, about what the message is from the Bank of England. Was that a hawkish hike? Was that a dovish hike? We got 25 basis points from the Bank of England today, but the economic outlook doesn't look particularly clever, and as a result of which we question whether or not we've got the 118 basis points that we've currently got priced till the end of the year in terms of hikes, are they actually going to really materialize? So the pound went down really sharply, as you can see. We're trading sub 124, the UK 10-year and the UK 2-year. Look at this UK 2-year absolutely shooting to the upside, to the downside. Bonds catching a massive bid. I talked to the governor after the decision. We're going to play some of that interview in just a moment. That's next. This is Bloomberg. Thursday, May the 5th. European stocks are going nowhere in a hurry. US stocks completely round-tripping off the Powell press conference yesterday and are now falling rapidly. The dollar is super strong. The focus over here is on the Bank of England. To be honest, these are very confusing times. We're going to try and provide some clarity. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Okay, 30 minutes to go until the European close. Let's give you the price action. It's all over the place. Equities are actually over here reasonably becalmed, but take a look at what's happening in the States and you'll see a complete round trip off Powell. The Nasdaq in particular coming under significant pressure, but we are trading sub 440 or at 440 on the Stock 600. The action is elsewhere though. The action is certainly in the British pound. We're trading with a 123 handle. Was it hawkish? Was it dovish? I'm not even sure the Bank of England really knows the answer to that question. The pound trading sharply to the downside. Are we going to see the hikes? 118 basis points is still priced in terms of expectations of hikes for the remaining 5 meetings of the year from the Bank of England. The UK 2-year catching a huge bid. We're down by 12 basis points on that. I don't think there is a clear sense of where we're going here. Inflation is going to continue to rocket higher. Then apparently, according to the Bank of England, absolutely collapse critty. The Powell press conference, I think, was probably a little bit clearer, but I think reading central banks right now, super hard.
Yeah, Guy, I think it's interesting to when we're talking about whether or not the Federal Reserve was the exception to the rule when it comes to simply communicating to the markets, because actually when you look at what the market is doing right now, you really mentioned it. The S&P 500, the Nasdaq 100, selling off and selling off hard, really some conviction selling here, down 4% when we're looking at the Nasdaq 100. But even if you look at the S&P 500 on a sector basis, even energy, which oil prices are higher, even energy under some pressure. So how much of this is simply a risk-off move, even in a time when energy is supposed to be that defensive inflation trade? 10-year yield is quite a significant move. Now crossing that 3% threshold, we're looking at 304 on the 10-year yield, an 11 basis point move in just a couple of hours, guys. This is enormous. And when you see those interest rate differentials increase, you do start to see the dollar get stronger and stronger, really speaking to that weakness you're seeing in the pound, driving the dollar even higher, bouncing up against some significant levels in 2020 and 2016 as well. Does it surpass that? And what does a stronger dollar mean for the rest of the world? Of course, we're going to keep an eye on that. And crude, we do have some marginal moves here despite that OPEC decision. Standard 432,000 barrel, but also an announcement from the U.S., for the Biden administration, I should say, they're going to ramp up some of that SPR reserve. How does that really reflect into the markets? Is it priced in? We'll figure that out as the day goes on.
Well, let's get back and talk a little bit about what's happening with the Bank of England, Chrissy. I have to say I was on air at the time when the news broke. My initial reaction was this was a hawkish hike. Maybe others had that reaction, but once you dug into the details, actually the outlook for the economy turned it into a dovish hike fairly quickly. We saw a significant repricing. Basically, the Bank of England has issued probably its most gloomy outlook for a very, very long time, and certainly one of the most gloomy outlooks of any major central bank. The Bank of England is basically warning that Britain is going to face double-digit inflation and a prolonged period of stagnation or even recession. I spoke to Governor Andrew Bailey a little bit earlier on about the market reaction to this.
I wouldn't agree with the statement that the cure for higher inflation is higher inflation. But I just want to go one step behind that because I think it's important. We think that a lot of the work in terms of the cure is going to be done by the fact that we are experiencing a historically large shock to real incomes in this country coming from outside the country. So it's a terms of trade shock in that sense. Import prices are rising. That's predominantly energy, food and some core goods. So I just wanted that high inflation cures high inflation. No, of course it doesn't in a sort of what you might call a sort of standard demand shock where both activity and inflation are going up. But what we've got is inflation going up and this big push down on real incomes, and it's the real income push that is the thing that we think will do a lot of work to lower inflation. But here's the complication. there are risks the other way, and one of the big risks the other way is the labour market. We've got a very, very tight labour market in this country. Now, of course, it's a good story in many ways for broader society and economy, because we've come through COVID. There were a lot of predictions, including some by us at some times, that we were going to have quite a big rise in unemployment, and in the end it didn't happen.
Why are you so convinced that wages are not going to rise to meet the inflationary push that we're seeing? I hear what you're saying about the cost of living crisis, but nevertheless, there is a risk that we see wages going higher. You talked about this in the press conference. There seems to be a gap between the bank and business. I talk to CEOs all the time. What they tell me is they are really struggling to hire. They are, as a result of which, having to raise wages to compensate for that. And as a result of which, while at the moment wages are below where inflation is going to come down, but the labour market may stay tight, and we end up with a situation where actually that spiral starts to bite.
Well, and that's why we think there are risks on the upside to inflation, but we also think that the core story here is a big real income shock to the country, national real income shock, which will push down both on household income and company income, cuts down on corporate margins as well. And that, we think, is going to slow the economy down. It's going to slow demand in the economy down. And we're probably already seeing some signs of that. I mean, look at the gap between consumer confidence and business confidence in this country, which is quite large at the moment. We had and I never advocate putting too much weight on one number, but we had quite a weak retail sales number a couple of weeks ago. So we are seeing some signs of things beginning to happen. And we think, unfortunately, this shock to real income has to come through. I mean, there's no way it can't go anywhere else, unfortunately, and that will affect. But you're right. I mean, I go around the country a lot. At the moment, and this backs up the business confidence story, firms are saying, my problem is I can't hire enough people.
The Governor of the Bank of England, Andrew Bailey, speaking to me a little bit earlier on. Let's dig into the analysis around what we got. Liz Martins, HSBC's senior UK economist, joining us now. Liz, can you just talk me through what you saw today, what you heard today, and whether or not the market reaction is the correct one to what the Bank of England has put out?
Yeah, I mean, I think it is the correct reaction. Like you, I think the initial reaction was, okay, 3 members of the Monetary Policy Committee have voted for a 50 basis point hike. That probably wasn't factored in. That initially seemed to be very hawkish. But actually, when we read the minutes, it was saying, well, actually, these 3 members are a bit concerned about those underlying inflation pressures. And they think if we do more now, it means we will be able to do less later. So it might tell us more about when they want the tightening rather than how much tightening they actually want. And if we then drill a bit deeper, the BOE messaging still stands out as really dovish compared to other central banks. We had the Fed yesterday. So, for example, they're only saying we might need to tighten more. It might be appropriate. That does compare very starkly with the guidance from the Fed for we're probably going to do 2 50 basis point hikes in the coming meetings. The BOE is only saying we might do it. And 2 members, or some members, according to the minutes, said actually we don't even know if we'll need to do that. So that's very dovish. And then we look at the bank's forecasts, which you mentioned earlier, and they're forecasting a very sharp slowdown in growth, unemployment up to 5.5% from just under 4% now, and inflation down to 1.3%. And that would be the biggest inflation undershoot that they've forecast since the global financial